podcast.
We already getting, oh, here it is. Okay, we are now live. We were slow about going live, but now we are live.
Not we. I'm not taking any royal we on this one.
Yeah, I heard you had fun last week.
Christy,
Christy,
hello.
what's going on? Charles, Debbie,
They were
Forge.
all
They're coming in.
waiting
Jack
there.
Pratt, what's going on?
Kimberly, hello. Debbie, Tina, woohoo. Ryan, welcome. It is 3:01, so we are ready to start.
All right, guys, welcome to our Compliance Conversations hosted by Ilsa and your folks here at the Spot On Insurance Podcast. Today we'll be discussing social spot. What is that?
What you do there?
What happened at that?
I think we'll just talk about mergers and acquisitions.
Yeah, what did you do to me? Mergers and acquisitions in the insurance industry, guys. Always clowning me. Challenges and best practices. This is the last of this series. Next Thursday, please join us on our last webinar for 2020 as we wrap up the series, Staffing Your Compliance Team from Zero Knowledge to Expert in the Field. That's on Thursday, November 5th, still at 3 p.m. Eastern. And don't forget the time changes for you guys this weekend.
Only for you guys.
Yeah, Puerto Rico, we don't change.
Yeah, we'll stay at the same time. So thank you everyone for joining us. This is going to be a 1-hour session and we are streaming on LinkedIn, Facebook, Twitter, Periscope, YouTube, which Christian always reminds me to make sure that I give a shout out to YouTube because that is our primary platform there where we put the replays. If you have a question, just write them into the Q&A section. And if you just want to say hello, just say hello on the chat.
Okay, let me introduce our panelists. We've got Andrew Burnett, CEO and Managing Director of the Acela Group. Take a bow. Joanne Delgado, Vice President of Compliance and Education. She should be joining us shortly. We've got Michael Mensch, CBI Managing Partner. Dave Ravel, Partner, Head of Sales, Marketing, and M&A at Element Risk.
We get Dave? There he is. How good.
Oh, Mike Strakoff, Senior Vice President, Head of Insurance Lending, Live Oak Bank. From our teams, we have Russ Foster, our GM. He's in the spooky yard back there. Joyce King, our Special Projects Administrator and our webinar moderator. And Christian Masonette, our Spot On Insurance Manager, who will be keeping the live conversation going. Thank you, Christian.
So today we're going to be covering what to do after the deal has been signed. And last time we talked about, we actually chatted about a couple of the horror stories. Today we're going to keep it positive. We're going to talk about the success stories. We're going to talk about team integration. And we're just going to take away from all of our panelists some of the amazing things that they've been doing. And like Ted said, this is actually going to be our final M&A webinar. This is part 3
of the year.
And we're going to be talking, earlier on, we talked about how to prepare the agency for a sale, how to be successful throughout it. We talked about negotiation failures and transactional solutions which today they're not going to be with us. Corey Witter and Matt Schneider talked about a lot of the transactional solutions. So I'm looking forward to this, especially about team integration, which is so crucial. So Joyce, let's get the panelists to have some fun.
All right. Joanne, I want to start with you. You want to have some fun?
Always.
So we talked, I think it was last week, and you shared some information with us via email too, but you've been involved in so many mergers and acquisitions, maybe in your former life. And can you just share with us about some of the challenges that you've encountered? And we're talking about really more on after the deal has been done. What are those challenges?
So I think the greatest challenge is really bringing all the pieces together. So there's so much work that goes into getting companies ready to merge, acquiring a new company. But when it comes to the back end and trying to piece it all together, so we've picked a merger date and we're now backing into and need to get a lot of the operational functions all in place by that merger date. And so some of the challenges, licensing, for example, bonding, licensing, securities, and taking several companies and merging them together can be very challenging from the standpoint of having all of the individual and entity licenses changed over. Most states have reporting requirements whereby you need to report those changes within a 20 to 30 day period at a maximum. Mm-hmm. And bonds need to be changed. So there's a lot of coordination that sometimes takes a little longer than we anticipate going in. So I think the greatest challenge there is really from a back end perspective, keeping the operations side in alignment with the front end of the merger, right? So before we pick that date, how long did it take to get all this stuff done? Having a plan in place. The other piece is how you share information. And once that merger is completed, you may need information from the company that's merging in, and how to bring the systems together, how to get reporting in alignment becomes tremendously challenging. And oftentimes we're figuring out at the point that that paper or that reporting is due in terms of how to, I'm going to say, bring these two pieces together. You have individuals sometimes that you're using for that reporting. And are they part of your merger? What happens when they're not part of your merger? How do you give information to them, right? Because now we also have the privacy era, right? And so many privacy laws and the strictness of the privacy laws. And how do you now share personal information amongst many people? So
those are really good points, Joanne. And I know that like some of the folks that are here, like Michael Mensch and Mike, I think you guys, and Andrew, you guys are involved in the M&A process at the front end, right? So there's so much, like from our side, like on the compliance side, that has to take place afterwards, taking care of notifying the states of the designated producer. If there's any issues with inconsistent fees, commissions, right? Like if one group paid fees a certain way and another group paid fees another way. And it's not just all the reports that we have to do with the insurance departments, but we're talking about with the Department of Revenues, with the Secretary of State, all the changes in directors and officers. And Joyce, Joanne, both of you did an incredible podcast for us that's going to be coming out on Tuesday that's talking about all the back end stuff that has to take place with the mergers and acquisitions. And I can't stress enough the importance about doing compliance reviews before an acquisition. And, and if you don't do it before, just do it afterwards on that team that you've acquired. If you didn't do a compliance review beforehand, make sure that you do one afterwards to really assess any issues, any administrative actions with those agents that you're now are part of your team.
Joanne, one thing that you mentioned when we talked before was about the wording on quotes and binders, maybe not meeting regulatory requirements during that transition. Can you talk to us a little bit about that?
So similarly, right, it's systems and getting systems up to date. So at the point of a merger, company names need to have changed on documentation. Wording needs to be standardized. Arlene also pointed out commissions and fees. It is critically important within an organization that those structures are consistent from customer to customer. Otherwise, at least on an insurance level, you're opening yourself up to a big level of scrutiny from a state if one customer is, I'm going to say, being charged on a different fee structure than another. So as far as documentation goes, most times after a merger, you're going to need to have a merger document that is actually part of every transaction that you issue out that notifies, I'm going to say in the case of insurance, the insured of the merger, the date of the merger, future actions and who they need to report to. And once again, I call this kind of that compliance back end function. We totally forget about this. The merger happens and the first transaction goes out, but it's gone out under the other company's name because you really don't have the systems alignments in place yet. So making sure that you have notifications and forms that are notifying the insureds and providing them with clear information about the changes that just happened.
Thank you. Yes, and like Arlene mentioned, Joanne and I have done a podcast on this, which is going to release. What day does it release again, Arlene?
November 3rd, Election Day, Tuesday.
There it is. Where Joanne.
So standing online, you could be listening to Joanne and Joyce. Yes.
Well, sorry about that part, but it's good information.
Great use of your time.
Be on a line for a long time.
Yeah.
I want to pose a couple of questions, and to be very honest with you, I'm not even sure who these are coming to, but these were submitted to CC Questions right before we came online. So whoever, hopefully somebody can help cover this. If not, if it's meant for some of our panelists who weren't planned for today, then we'll get it in the right hands and we'll get the answer back to the gentleman that submitted the questions. But here are two different questions, and they're both kind of accounting related. But how important is good accounting, i.e. well-balanced trust account, receivables and payables that agree with the financials, including producers? How does that improve an agency's value? Can somebody answer that one?
I'll take a stab. I mean, I don't think it doesn't necessarily improve the value. It's if there's a lack of good accounting, that's going to be an obstacle to get through in due diligence. And that's really, it's expected that the financials records are well organized and everything is accurate. So if there are issues with trust accounts and record keeping, it just becomes an obstacle to get through during the due diligence process. So I think that's the short answer.
And I think for whomever submitted that question, they should actually probably listen to the replay on our first webinar that we covered, which was on how to prepare your agency for a sale, right? We're talking about, you shouldn't just say, oh, today I've decided that I want to put my company up for sale and formally put it on the market, right? Like I think Michael Mensch mentioned, this takes sometimes years of preparation, right? So your books have to be in good order, and your team, and there's a lot that goes into it. So probably number one thing is your financial statements.
Yeah, and the only thing I would add to that is that if there is some discrepancies or concerns with the financials and the trust account, what have you, I think it really opens the door to really anyone who's looking at them to question everything at that point. Because that's really the starting point of where the expectation is there that it's run right. And if there's concerns that it's not, I think it creates other areas to look into maybe a little harder than you would if everything was not well managed.
Yeah, good point.
Thank you. Same person, second question. How does bad accounting records, aged, collected, and advances, trust account shortages, unreconciled bank accounts, and other unknowns affect the valuation for a potential buyer?
We're going through a situation right now where they have about $180,000 of AR because they had a lot of accounts on the books where what they were doing was functionally, these were clients they've known forever who you hear it every time, like they have some cash flow issues, they're great folks, and so they functionally fronted premium for them. And when we really looked in the AR, some of these are years and years old and they're never playing catch up. So what we actually do from a valuation standpoint is we remove that client's value completely from the revenue because we cannot operate like that on a go forward basis. So we automatically assume that under our way of doing things like current and all those kind of things, we automatically assume that that client is going to be upset and move on. So that's the way we de-risk the reality of a lot of AR. And we are seeing some of that kind of coming to a head right now on a few people that we're speaking with.
I want to just have Russ or Ted jump in here. I don't know, I'm sure you guys remember pre-Great Recession, how much we had in outstanding AR. And that was a wake-up call for us, you know, like I think it was like 2009, or when we
Yeah.
were just like, oh my gosh, we can't just function this way, figuring, oh, that money will be coming to us in a short time. And we totally revamped the whole way that we bill.
Well, it was a scary moment when all these companies were going out of business all around us, and so we got out and talked to those that we had been lenient with and said, sorry guys, you got to pay up now. We don't know where this is going, how far down things are going to drop. We don't even know if you're going to be in business in the next 6 months or so. So we're going to have to change that. But that, like Arlene says, that became a wake up call to us that going forward, once that mess was over with, we were going to have it so that we had a great collection system.
Well,
We got the money in.
taking the cash in advance was the main thing that saved our hiding.
Yeah.
We had carried so many clients for so long. I mean, it really put
Mhm.
us in a cash flow issue. It was pretty scary. I remember it well.
And oftentimes those clients that where that is done for are some of the agency's largest clients. And the
Yeah.
reason it's done is because there's a fear of loss of that client. So when you think about your valuation as an agency owner, if you have your 3 top clients happen to be in that scenario, and someone's going to remove their value from the book of the business, that can exponentially impact your value at that point.
Good
As we
point.
provide services, it was really easy for those really big clients to get into us for a lot of money quickly.
Mhm.
Yeah.
Do their projects, we'd invoice them, and we're waiting and we're waiting and we're waiting. Money wasn't coming in.
We were fronting state fees.
Going to the question too about how that impacts value. I mean, so we handle due diligence for buyers as well. And I mean, you pay based on what you can verify, right? So if the accounting is, you can never get through to figure out what the actual commission revenue was, then the buyer's just going to pay on what they can actually verify. And so agencies that have a lot of agency bill and don't have a good accounting system for that, it's a real problem. There are a couple deals that we were on the buyer side trying to get through for due diligence for them, and we just had to throw our hands up and say, we're not going to get through this. We can't prove the revenue. It was all agency bill. So it impacts the value because, again, the buyers usually, if they pay one based on what they can verify, but if they can't even verify and get comfortable with the numbers, they may just walk away from the deal.
Another thing I would throw out there as far as the value, and we're saying good books, but good record keeping, good documentation, I would say even goes beyond the books, because another thing from an agency valuation standpoint that we're seeing is just like, call it a producer that has a handshake agreement. That's a big difference too from a buyer's perspective, because it's not like locked down per se. There's no reason that person couldn't go on. And to Mike's point about you pay based on what you can verify, you also pay based on what you would like expect on a go forward basis. And so those type of big question marks can really impact value, or even the deal transacting in the first place. So if you think about getting your books in order, I would add contracts to that books mentality as you're preparing for a sale as well.
Yeah, we see a lot of people come to us with kind of a model where it's 1099 producers. So they're coming and basically parking their business or running it through the agency where there might not be that formal arrangement that you're talking about, Dave. And that makes us nervous on who actually owns that book. Who can someone walk with those clients with ease? And, that is kind of a careful look at the bookkeeping sometimes to figure out that there are outgoing payments in a 1099 that you want to investigate a little further.
Yeah, and touching on that topic too, I mean, since we're going down that path, I mean, the 1099 producer situation, most of the national brokers won't do that. So we typically will go in and true that up to, add the payroll taxes and everything. So a lot of independent agencies will take a producer under whatever contract they can negotiate. But when you go to actually sell, you're going to have to restructure the arrangement with some of those producers in a lot of cases, and that can be an awkward conversation. So that's one of the other things that requires some planning in advance, because you don't want to wait till the transaction's getting ready to close and try to negotiate a change in terms to the producer's agreements.
Very good.
Excellent. Excellent conversation on this. I'm really glad those questions came through right before we started. Dave, I do have a question for you. So now the deal's done. Okay.
Mhm.
Talk to us about some post-merger and acquisition goals.
Goals to get everybody on the same page as quickly as possible is the goal. But two, we always we want to create an expectation. We want to give context we actually have a whole onboarding process where we give context to the team that's remaining, because I think a lot of people's first question is, do I have a job? So we want to say, hey, this is why your previous owner chose us. This is who they are, and for us that is a very easy message, because we're keeping an office open, we're keeping the staff, we're going to invest in that community. So we want to say that, and it's just kind of like a bringing the temperature down is probably the first initial goal. Just to let everybody know who we are, get a chance to know them. We literally sit around the table or go out to eat or something, sometimes offsite, to kind of just take that temperature off of it. Everybody's got their job, that kind of thing. But then we do have to set the expectation that for us, and the value of us is that we are all on one system. And we always try and give everybody the why. We want to communicate that well. We're on one system, so that if you go on vacation, if you were part of a 4-person agency and in the summertime you had to coordinate vacations because the clients wouldn't get service, now you're part of a team that can have your back while you're gone. But the only way we can do that is if everybody's in that same place. So there's a lot of, I think with any communication, a lot of expectation setting, but that goal is so that everyone can be on the same page. And every culture, no matter how good or bad a culture is, it's going to be different than another one. So it's kind of, we actually, one of the first things we do is we talk with that team and say, what are the good things about your culture that we can replicate across the organization? What are some of the bad things about your culture that you might want to leave here today? And have that out. So right away they have a voice, but with the very clear expectation that there will be some changes. And some people can roll with that, and some people get very freaked out, and then it becomes a one by one, managing individual expectations after that.
Very good. So let's talk about teams, right? And want to talk about what various ways have you seen teams being incentivized to stay on after the acquisition? So let's start with Michael Mensch. Let's actually talk about some, and I wanted to throw this question out to Stephen today, but he's not with us. So I wanted to talk about some of the employment agreements that you see, and maybe some of the financial incentives that are put in place, before the deal is signed to retain those team members.
Yeah, great question. So, every buyer goes into it and says that they don't want any of the employees to go backwards in compensation. So, typically key employees, we recommend our clients that if they've got a key employee that is in charge of the books and records and everything, that because a lot of times these agency owners don't really get into the accounting and management system themselves. So if they've got a key employee, that they really should bring them in on the transaction early, so that way they have somebody that can run the reports and everything that they need. And they'll usually give them some kind of bonus for assisting with getting the deal done to the closing line, or assisting through the transition period. And it could be 1 or 2 employees that they do that for. In regards to all the other staff, it depends on the buyers. The large national brokers will typically want employees to sign the non-solicitation agreements prior to funding the transaction. So they'll get everything. The contract will be pretty much done, and that's going to be one last deliverable is, okay, the owner's got to go out, talk to all the staff, let them know what's happening, and get them to sign the employment agreements. So, smaller organizations don't have to follow that protocol. And a lot of times the smaller deals, it's close the deal, then you get the employees involved. But I think generally nobody wants to upset the apple cart with employees. So you don't go in there and fire people or change their compensation all that much. It's trying to keep things as steady from, you know, before the deal and after the deal. So, but a lot of times we'll see where the buyers want the employees to sign off on the employment agreements before they'll close the deal even.
Andrew, have you seen what type of incentives have you seen to retain the talent?
Yeah, absolutely. Actually, a deal that we're closing in a couple days, it was a key manager that came along with the deal, and we pretty much carved out a strong employment agreement with him. Again, 3 to 5 years. Actually 3 years, but with incentives to even make that longer because of the value that they brought to the table. Additionally, what we did is that we also structured an equity type compensation so that they would share in the profits of, so we're helping our client buy this entity and have it operate as a new division. And so we actually had him share also in the profits of the new division. And again, him having the same feel as if he were an owner. And that seemed to have worked out well also. There was a point I was going to make, as we talked about before, like when you're buying or setting up to sell a company, the three areas that you have to look at: one is what you're selling, identifiable; two, is it financeable; and then three, is it transferable, right? And so post-acquisition is really about transferring those assets so that they operate in the same way that you've intended. So one of the things that we do as an M&A advisor is also we actually continue to work with the company during the transition period. And typically our rule of thumb is we make no changes for the first year because we don't want to upset anything. We don't want to change culture. We wanted to operate, and our goal during the first year is really to observe, and then once that year is up, then because we've established relationships with the team, we could then make changes in a way that is beneficial. But we continue to serve as advisors during that first year of transition. Yeah.
Arlene, could I add to the conversation?
Absolutely.
So, and this is more from a prior life, but somehow the incentives, a lot of times the buyer will come in and create some level of earnout. So there's expectations post-close that you got to hit certain levels, and there's compensation ramifications for either hitting them or not. And you see some sellers at times, and the buyers, with the buyer's blessing certainly, to tie those like key employees or producers into those numbers. So if the number is growth by a certain amount and there's a payment by the buyer down the road in year 1, year 2, year 3, that you tie the producers to that to say, hey, if we hit these marks, you then get a bump in compensation. So ultimately, everyone wins, particularly on the sell side, including the employees, that their incentive to hit the numbers that are put out there by the buyer in order to generate this additional compensation, in which they so you have the common goal with the opportunity for everyone or some people to earn more if they hit critical metrics that are included in the earnout. And that seems to kind of get everyone rowing the boat in the same direction and keep everyone engaged during the transition.
Cool.
Very good.
Good information.
And Joanne or Dave, if you guys want to add to that, feel free to. You good?
I think the transferable part is, I always call it the soft part, because it's really now making it all come back together again as a new company and a new entity, and there's a whole change management piece. So I think Andrew's point was super on target with kind of those three components, and really that back end piece of bringing it all back together. Because I hate to say it, but on the merger day, it's a merger. In most cases, you don't have a lot of time to ramp people up. So it's really important in the process of preparing that everyone's ready for the changes that are going to take place, that you're keeping things as steady as you absolutely can, because of course that's always the goal. But it really is kind of having an idea of how the things that do have to change, how they can change in, I'm going to say I don't know what word to use, but I'll say in kind of a very pleasant manner, as easy to kind of implement change as you can. And so it's really important to have somebody you can work with that can help the employees and the staff move through.
So Joanne, you're saying you want the honeymoon period to be really good.
It's really important. It sets that tone, right? It's your tone for moving forward.
Yeah. Got it.
Yeah, and especially for as looking at it from a financing point of view, when if you've taken out a loan to pay for this acquisition, you have to make sure that the company's operating in a way that meets your expectations. And so you really don't want to upset a lot of things. And however, you still want to make sure that you're hitting those milestones from a financial point of view also. And that's where, the rubber hits the road, because you once you're in there, you really get to experience whether those numbers were really right. And you really have that first year post-acquisition, post-merger, is when you really have to bring all those things together to make sure that financially you're getting those results.
The only thing I would add is that at some point in a negotiation or a deal transaction, you go from kind of the Andrew's point, you're talking about the finances, and there's a negotiation happening during that time. But on both sides, you need to protect some level of what I'll call relational capital, because at some point the negotiation's over, and now you heavily need to work together to get that onboarding buy-in from key leaders, key employees, that kind of stuff. So I think that's important when you're thinking through the deal. And I think, Andrew, in our first call, you mentioned a deal that didn't work out just because just wasn't jiving, or I forget the word, but that's that emotional capital that when that's not there. So as you negotiate hard and everyone wants to capitalize and maximize their earnouts, but for both sides of it, because both sides are negotiating hard, for their interests, I get that. But there needs to be that level of, hey, we also can really work together. Or I've seen situations where, I don't know, just something about, I really like that person. And those are the things that kind of carry you through the bumps. But I think part of maximizing as a seller, maximizing your earnout is that relational capital as well. I think it's important to have that on the radar. It's intangible, but it matters.
So we have a question that came in through the Q&A. And as the question came in, Andrew, you were kind of answering it. So I'll ask this to Dave, and then Andrew, if you still have any more to weigh in on it, please do. But the question is, post-merger acquisition, how long do you let the acquired operate as normal before integrating them into the systems and process of the process of the new parent, and then why?
That is a great question. Everybody can handle different levels of speed on that. So I would say to answer it shortly, I would say about a year. But I think that's some of the points that have been spoken about, is there's a lot of proving out your financial pro formas within that year. And that's very important. You don't want to refine it so much, but lose key people in the process of getting better, so that's really important. Taking it slow. And we always use a boat mentality. And we literally say this every time. Listen, you guys are a boat out in the ocean. You're doing your thing. Our boat's going to come alongside you. And then we're going to ride together for as long as it takes for you to feel comfortable, and for all your, as a team member, walk across the planks onto our boat for your systems, for your clients. We are going to be together. And then at some point, our boat will keep moving forward, and you'll kind of sail off. The old way will kind of sail off into the sunset. But don't worry, we're going to be together in this until that time is right.
Scuttle the ship.
So sometimes to a lot of people's credit, we've been able to speed that process up. But there's so much like fear management in that, like, but I've literally heard, someone that sold to us because the other person they were thinking about selling to came in the day after the transaction was complete and the money was funded and removed all the files from the office, turned off the old management system and said, here's your logins to it, a brand new management system with no data conversion, with no, so yeah, we always say we are in this together. And we try and really say, and it's true. So we use that boat mentality. All your stuff's over on your boat. We're gonna be together until it's on ours, and the old one can go into the sunset. It's all good, no rush. We say that a lot,
Yeah, and the point that's really good about that is really getting the buy-in of the key managers. And I think once they are on board and they're comfortable with how they're going to be protected, going forward, I think that really helps to create positive energy in the organization going forward. And so that's based on their compensation package, how well, you've communicated the transaction to them, and then the plan to move forward and how they're included going forward. And I give you an example. One company that we work with, key manager really like ran the company, and the seller, as part of the agreement, he looked at her as like a daughter. And so he wanted to make sure that after the transaction that she would be protected. And, he actually made that possible in the deal and, really pushed for it. And, post-merger, post-acquisition, things ran very smoothly. And, she continued to play that key role in the business. And, when I was in business school, one of the best classes that I took was management of people at work, right? Which made no sense at the time. And if you look at business, is really about managing and motivating and inspiring people. And at the end of the day, that as an acquirer, that's what you want to do. You want to make sure that the people that you're now aligned with are inspired to work with you and, as a team. And, that's, really, I think someone mentioned the relationship capital, that you're really investing in the people when you buy a company. And because they're the ones that are going to produce all the revenue and profits. So you just want to make sure that you do a good job at that.
If I could just,
yeah, go ahead, Mike.
just real quick, and I think I agree 100% with that first year being critical. We see at times people will come to us and say, this deal makes a lot of sense if we make all of these changes to the agency that we're going to acquire. And that might include headcount, that might include moving the office, it might include a number of things that on paper definitely equate to a significant or potentially significant savings that makes the economics of the deal work great. But with all of this said, where we all could agree that, the first year, months, it's essential that you kind of keep to where, the agency was operating beforehand. You can make some exceptions. So we get pretty leery when we see a pretty aggressive pro forma on all of these things that need to change the first year in order for the deal to make sense. We kind of see it a little bit more conservatively, saying maybe all this isn't going to happen in the first year, the first 6 months. And it's something that, I think people look at deals on paper a little differently than the relationship side and what's realistic, in the first year and what you can accomplish. So maybe a word of caution as you're looking at the numbers, maybe sometimes too many adjustments too quick can be problematic for the long-term relationship and the transaction.
Very good points. So on mid-size to big players in the market, in the insurance space, there's always, or there should be, integration teams. So let's talk about the type of folks that should be on the team, the type of skills that they should bring to the table. Dave, let's start with you.
We have, for us, we have IT is one of the main things with integration, and IT goes beyond. We've made the mistake of IT being hey, you're on our system now, and failing or fumbling on the training and the follow up and some of the additional things that go along with IT as part of making those people feel comfortable. So we have an IT person, we have an acquisition coordinator who what they do is their licensing, their carrier appointments. They'll analyze those different things. Then we also have regional leadership that come in and kind of like it gets to earlier points, but we want to make sure that there's an understanding of the vision of the organization. And it's been really, really neat because sometimes you see people literally like come to life. We've had people come and say, I was hoping for an opportunity like this. Oh my goodness. And I actually really want to do this with my career or whatever. It's fantastic. So we have leadership, IT, licensure, and actually that's somebody I would love to get in touch with you guys, honestly, from some of the things I've learned. Her name's Sarah. I'd love to connect her with you guys after all this. But then also marketing. Our marketing department really does a great job of listening for quite some time and then coming on to support. So we offer those 4 things at a corporate level, and then also accounting is those 5 things. Excuse me, I forgot accounting. So those are our teams, and all those people need to be good at their craft. They really need to be people as well. So we've ran into that before. Someone who was excellent with accounting wasn't great at like delivering that message of why billing needs to be done a certain way, or patience wasn't their top 3 strengths, let's say. So making sure that those people are great at their craft, but also have that people component too, because everyone's watching and they're kind of saying, can I trust this company? Can I, what does my career look like here? And if all those data points are checking out for them, a lot of times you watch the buy-in start to happen. And to some of the points that were made earlier too, especially if it's those key people that are natural leaders within their organization or within their division, people are watching to see if they buy in, and if they buy in, now we're in, that kind of stuff. So those are our five people.
Very good. Andrew, Joanne, did you guys want to talk about what type of skills should be in there and those folks that are helping integrate the 2 companies?
I'm okay. I think Dave did a great job with that. Definitely hit all the points.
And I would second that. I think Dave covered it. And if all of those things are working well, you are in a great position moving forward.
Very good. Very good.
I have a question, Andrew. If you had to put together just a quick post-merger checklist for our listeners today, what are some of the key points that would be on your checklist? Dave and Joanne probably going to come to you with the same question, but let's see what kind of checklist you 3 collectively would put together post-merger acquisition.
One of the things, again, I deal in companies outside of the insurance company, right, in the insurance industry. One of the things that's also good to do is visiting your key clients, right? You want to make sure that those key clients are also on board. So one of the first things that we would do is make sure that we go out, introduce ourselves to those clients, and establish the relationship along with some of the existing members of the team. Secondly, I think the checklist is also looking at contracts and making sure that those are verified. I'm just trying to. I think that the customers are the first thing. 2 is also in making sure that we can get into the financial systems, and we're able to begin monitoring the financials. And I think what was mentioned before is also looking at security issues related to IT also. So financial, IT security, and paying attention to that also.
Thank you.
I have a question for Michael Mensch. Um, so what have you seen done contractually before the deal is signed so that the acquirer is making sure that those key folks are going to be in place? Incentives. How do you see that come across in employment agreements, whatever?
Sure. Well, I mean, the number one is having an earnout in the deal, because that, the business continuing and having a financial incentive basically for the business to do well in the future is going to help. The other thing is, a lot of times there'll be like a transition services agreement that's part of the transaction, because in the insurance world, you close on one day. It actually takes months to get everything transitioned over from the carriers to the banking and everything. So it's not like a flip the switch and everything changes over. So I've seen a number of deals where the buyer puts a transition services agreement together saying, Mr. Seller, or Mrs. Seller, you're going to continue to help us through this period of time, changing over the employee benefits, changing the banking and everything. So there's some of that, but yeah, you can have escrow hold back at closing where money's held back to ensure that the seller helps transition everything over. Usually the employees are mostly afraid of losing their job. So, day one, the buyer wants to should get in there, talk to them, comfort them, offer them employment. And as long as they've got continued employment, I mean, and nothing really changes all that significantly, that usually the employees will stay on unless the buyer comes in and changes things. Or, the worst thing I ever saw happen was, and this was a big transaction, the agency had over 5 million of revenue, the one that was being acquired. The buyer was a private investment company, and the guy who was in charge of the deal basically said, I'm not coming down there for 30 days after it closed. I don't know what he was thinking, but they didn't come down for the first 30 days at least. Well, I got subpoenaed much later than that because they ended up in a lawsuit because long story short, his whole strategy was just completely bad about how he wanted to handle that transition. He thought, well, I'll just leave it alone. We'll come down when we come down. They lost $1 million of revenue over about 18 months and ended up getting into a lawsuit with the seller. But it was really the buyer's approach to the whole process was horrible. So that I like to give you guys bad case examples because that's what people remember, right? I think the right strategy is boots on the ground day one, go meet the employees, make them feel comfortable, have all the employee benefit in the handbook out, walk through that with the employees. You've got to have a proactive approach, have a letter ready to go, in the case of the insurance world, have a letter that you send out announcing your company to all the clients of the agency. The other checklists are getting the carriers to transition, getting the banking switched over, getting the utilities and everything. So the first 30 days, there's a lot of that little minutia that has to be handled, with just switching over day-to-day things. But the most important is getting in there, immediately comforting the employees and making sure everybody understands that it's going to be okay, and a lot of times these are bigger organizations that are making the acquisition, so they can talk about the new benefits the employees will have as a result of the transaction. But don't just close on the deal and don't show up for 30, 60 days. That's a not do.
Noted.
Hey, we had another question come in from the Q&A. I like this. Whoever can answer this. Have you ever had a situation where the seller has had trouble letting go?
Ooh, Can I jump
Dave,
in on
yeah,
that?
yeah.
This couldn't be more. This might be the guy I'm talking to right now.
Oh my
Um,
gosh.
we met with. I'm not even kidding. We met with a gentleman today who we were supposed to close right before COVID happened. So that was kind of the first hiccup, and I totally understand that. You just want to see how it was all going to shake out. Then there were reasons, and now we're supposed to close 12/31. We had a meeting today. We went in literally ready, very excited to see the office, all this kind of stuff. And it was just, guys, I don't know if I'm ready. And so yes is the short answer. One thing that came out, he actually literally said in the meeting, what is wrong with me? He was acknowledging that he is really struggling with letting go. And one thing that Josh and I kind of evolved in our conversation was, he started his agency from scratch, and this really was his baby, and his team was, yeah, absolutely. And so like when that evolved out, because at first it was kind of like, hey, just make a decision, and you're kind of wishy-washy and but we realized that many of our acquisitions were multi-generational situations. Some didn't even want to be in the position that they were put into because of just the way it went down, and this was different. This is their baby. And so yeah, and so the advice that we left, that this is fresh. This is hours ago. Literally the meeting was at 10 o'clock this morning. We just said we would encourage him to really think about why it is that he's selling, and what are those things, and then also do it when he's ready. At the end of the day, never forget, it's their business. So if you're a seller listening to this and you don't feel ready, it's your business. So if everyone's telling you to sell, maybe it doesn't make sense for you to. There's a lot of emotion in it, and even more so if you happen to start from scratch, I would add.
I'll interject something. Where we see the most difficulty for the seller is when they are the top producer in an agency, and they're making very good income. They're generating a lot of the revenue. So they're kind of a solo producer supported by some CSRs. And they know they've got to exit. They know they've got to eventually pull themselves out of the business and retire. But the amount of money they're making, being the revenue generator in the business, compared to once they sell, then they switch to like a producer role, there's a big income gap. And so it's that those agency owners where they're the key producer, those are the ones that we see have the hardest time to take the step to move forward with selling the business, because they're going to go from high income to much less income, but they got to keep working for a couple of years.
Yeah, I guess I have a horror story of someone willing to let go again. It's a different industry, but I had an owner of a business that was 90 years old. 90 years old. And yeah, I get all the tough ones, right? And literally, we were going to buy the business, brought me on, and raised all the money to buy the business. And he still wanted to be involved. And I guess it goes back to what Dave is talking about. This was a third generation business, but he helped to take the business to such a level that his predecessors couldn't. And 90 years old. And so one of the things, the stories that came out of it is that, unfortunately, he felt that if he gave up the business, he would probably die. And he actually said that in the meeting. And it was a sobering revelation, but we ended up not buying the business, and he's still running the business at some level at 94 years old. So, yeah.
Unbelievable.
She promised to leave him a desk there, They'll always have a place.
Mm-hmm.
Well, part 2 was actually horror story week, so I don't know how this happened.
Hey, I got to tell you, you learn some of the best lessons from these horror stories. They really stick with you, and they're usually vital.
Yes, definitely. We've got 5 minutes left. I don't know what kind of wrap up you might have, Arlene, but I think we wanted to end today on the good stories, the success stories, the happy stuff.
Yeah. Talk to us about some of the best, maybe the quickest integrations, the teams, how, they've joined the new company. They absolutely love it. Success stories. Dave, let's start with you.
When I think about one of our biggest success stories, it was a small agency in Front Royal, Virginia. They had 3 people, and at the time, just kind of small, steady Eddie kind of thing. We actually went to the people that were there were great, but then we actually went to Mike's point earlier. We went to open a bank account. There was this young woman there who was just full of life and energy. And literally, we walked out of the bank, looked at each other, and said, "Are you thinking what I'm thinking?" And we walked right back into the bank and got, like, "Hey, here's our card. Let's, we had coffee, all this stuff." Long story short, she is now, learned the business, leader, big time, like just does an unbelievable job with the team. She leads the region, and all of Virginia reports to her. She has brought so many people from the banking industry into the insurance industry. It's not even funny. But just watching a person bloom might honestly be more rewarding than business. I don't know. Watching a person, pursue their potential and getting to it, A, support it, and B, be along for that ride, and just getting to that's everything. And so we've had a couple bright spots like that, throughout the time. And so the stories are the people, in my opinion, and watching some of those people grow within the organization. There's nothing better than that.
That's awesome.
Joanne, have you experienced some really good acquisitions that you feel like have gone so well?
I would actually share the same. It's more in seeing people thrive and flourish as a result of the change that is the most rewarding piece. I think, and maybe some of it is fortune, some of it is the limit of the types of acquisitions that I've been a part of. But the acquisitions have, from a financial perspective, been successful. So I feel like that piece, all right, you do a good job, you do good diligence, you work your butt off once it's done to get everything in place. But it's really seeing people, the retention of people, the growth of the business has been the best piece of it. I would have to agree with Dave. That's the best piece of it for me too.
That's very good. Very good. So I just, we have like a minute and a half to go. I want to remind all of you that on Tuesday, Joanne and Joyce will be covering all of the compliance tasks that have to take place after an acquisition on the podcast that's coming out on Tuesday, and that's on Spot On Insurance.
Yeah, one of the things COVID has taught all of us is that nothing is guaranteed. And it's so important to be prepared professionally, have different skills so you can pivot when things happen, be ready for anything, basically. Learn by reading, listen to podcasts like Spot On Insurance, and, taking courses, getting designations. You're in the insurance industry, attending conferences, which now they're virtual, but, there's a lot of learning that you can do at these conferences right now. And guys, if you need compliance reviews during M&As, just call our compliance team at 254-729-8002. We don't do many of these, but I guess that was a shameless plug.
That was a shameless plug.
If you need help, and it is important, we talked about how important that is, we do compliance reviews for you.
And operators are standing by.
Operators are standing by, and they're all in the United States and Texas. One other thing is next week will be our last webinar for 2020. And it's going to be on staffing your compliance team. So next Thursday, November 5th, 3 p.m. Eastern, we're going to be, since you guys are changing the time, we're going to be 1 hour ahead of you guys now. So we'll be in different times. Well, we'll be 1 hour ahead of East Coast. We'll be 2 hours ahead of Central. So it'll be 4 p.m. for us. But we hope that you guys will be able to join us. And to you panelists, man, kudos to you guys. You guys have been awesome. thank you so much for having, shared your time with us and delivered all this valuable information. We truly appreciate
And we hear
it.
over and over again how valuable it is to the people who have joined us throughout. So thank you.
Great.
Yeah,
Hey,
thank
thanks
you.
for inviting us.
Thank you.
Thank you.
Bye, guys. Happy Halloween.